Hey everyone, and welcome back to The Explainer. Today, we're doing a deep dive, and I mean a really enthusiastic deep dive, into the May 2nd Convergence Brief. This document is just fascinating. It does something incredibly powerful. It takes the predictive probabilities from the Polymarket Macro Monitor and overlays them directly onto the hard technical realities we see in the weekly report. Essentially, we're looking at that exact intersection where the what if meets the what is, to unpack a massive shift in the macroeconomic landscape. And spoiler alert, the market is definitely not as calm as it looks right now.
Now, really quickly before we jump into all that juicy data, I do need to run through our standard disclaimer. The content presented in this explainer is intended solely for general informational and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this explainer without seeking the advice of a qualified financial professional. This explainer is an AI-generated product produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. Copyright Reflections of Reality, all original content rights reserved. All right, let's get into it.
So here is our roadmap for today. We're going to look through two distinct lenses, prediction markets and the tape. From there, we'll explore where they converge, dig into a really interesting anomaly, and then wrap up with the rotation map trade.
Okay, let's dive into this. The big question on everyone's mind, is the Goldilocks era over? For months now, we've basically been coasting in this smooth, comfortable market drift, right? Not too hot, not too cold, but the Convergence Brief highlights a major conflict brewing right beneath the surface. We're looking at a transition away from that pure Goldilocks drift, moving toward a much grittier, stagflation-inflected reality.
Starting us off with Section 1, Lens 1, Prediction Markets.
So, to gauge these extreme macro predictions, we're using the Polymarket Macro Monitor. This shows us where people are putting actual money on the line. And you guys, look at this massive statistic, 99.6%. That is the current market-assigned probability of Kevin Warsh being confirmed as the next Fed chair. That is virtually a done deal in the eyes of the prediction markets. And this is absolutely huge, because Warsh has a notoriously hawkish track record. He's got these heterodox views, even flirting with the idea of a return to a commodity-backed currency. That 99.6% is signaling a massive hawkish monetary regime shift that traditional markets are frankly completely underpricing right now.
And the dramatic tension really builds from there. Check out this next probability, 29.5%. That is the market-assigned odds of a U.S. invasion of Iran before 2027. Think about that for a second. This represents an unprecedented geopolitical tail risk. It's embedding a risk premium to the market that we literally haven't seen since the oil shocks of the 1970s. And when you pair that with a 33.5% probability that the Hormuz blockade extends all the way through the end of May, you are looking at the recipe for a very serious supply shock scenario.
And this brilliantly illustrates the tension brewing over in the systemic tech sector. What we're looking at here is NVIDIA's probability of remaining the largest company in the world. In May, it's looking invincible, sitting strong at 81.2%. But look at what happens just 1 month later. It decays down to 69% for June. That 12-point drop? That is a massive mean reversion signal. It really highlights fading dominance and a growing skepticism around mega-cap tech concentration, especially as the whole AI leadership narrative starts to look a bit more fragmented.
All right, let's flip over to Section 2, Lens 2, the tape.
Okay, so we've seen the predictions, the what-ifs, but what is the institutional money actually doing? If we pull up the weekly market intelligence brief and look at the S&P 500, we're seeing record high price action. Everything looks great, right? But wait, look at the bond flow. It's showing massive duration destruction. TLT liquidations are sitting at a negative 24.5% over the week, and IEF is down a staggering 36.4%. Guys, these aren't just minor portfolio rebalances. These are heavy conviction trades that are actively pricing in that hawkish Kevin Warsh reality we just talked about.
Which brings us to a really fascinating divergence that the brief calls the health versus price paradox. So the S&P 500 recently closed at a record 7,230. However, if you peek under the hood at the internals, health breadth is sitting at a totally bearish 46.4%. The paradox here is that the price is actually leading the internals. Market breadth is eroding right beneath the surface that looks totally bullish to the average observer. And historically, When regime change environments resolve, those internals usually catch up to the price. And yeah, that usually means a downward correction.
Moving right along to Section 3, Convergence, where the signals actually agree.
This right here is the absolute climax of our explainer. Convergence is defined as the exact alignment of Polymarket's macro regime predictions with the tactical signatures found in the weekly report's tape. Basically, we are hunting for those exact moments where the what-if perfectly matches the what-is. When two totally independent systems like this shake hands and agree, that's when you know you've found the true signal cutting through the market noise. And here is exactly where they are firmly agreeing. Both lenses emphatically point to a hawkish Fed. Polymarket is showing a measly 4% chance of a June rate cut, and the tape backs that up with the massive bond liquidation we just looked at. They're also totally aligned on energy. Polymarket is warning of a protracted Hormuz blockade and stagflation, while the tape shows the energy sector aggressively leading the market. Specifically, oil services is up 129 points. The signals here are completely locked in.
Next up, Section 4, the anomaly, conflicting signals.
Now you might be wondering, where do these two incredibly accurate systems emphatically disagree? Well, here's the sharpest contradiction we found. Polymarket's macro thesis strongly suggests you should be going long on gold and the US dollar, using them as safe haven hedges against all this geopolitical chaos and monetary regime change. But check out the tape. The tape shows that GLD and UUP are actually in liquidation. Gold ETFs are seeing institutional outflows. Remember, in this kind of analysis, the divergence is the trade. It's not just noise. It tells us that either the prediction market is early or those traditional safe haven correlations are literally breaking down under the pressure of stagflation.
Finally, let's look at Section 5, the rotation map trade.
So the crucial point is, how do we actually trade this? Moving from macro theory into practical application, the convergence brief maps out market flow based on momentum, splitting it into 4 quadrants: accumulation, rotation in, rotation out, and liquidation. Institutional money has to go somewhere, right? And this map basically tracks its exact footprints in the sand.
The message from the map is unmistakable. Up in the accumulation quadrant, energy is the clean, obvious story. Names like XLE and ExxonMobil are catching incredibly strong institutional bids. Meanwhile, over in rotation out, megacap tech is fading fast. Heavyweights like Nvidia and Microsoft are losing sponsorship at an accelerating pace. And down in the liquidation quadrant, duration is just getting destroyed. Treasuries like TLT and, surprisingly, even gold are seeing heavy outflows.
So here's exactly how this convergence is being played in the books. For the SPY and the KISS portfolio, the stop was recently updated to 627.62. The system is flat out refusing to add risk while market breadth deteriorates. For megacaps, MSFT and NVDA and the MAG's NSD book are fully exposed to that decay narrative we tracked earlier. But the real standout here? That's ExxonMobil, ticker XOM. It's a brand new entry in the Beacon 1 book because it has this super rare triple play alignment. Sentiment, flow, and options positioning all confirm it belongs perfectly in that accumulation quadrant.
So as we wrap up today's explainer, I really want to leave you with a provocative thought to chew on. If that geopolitical tail risk actually hits, if that 29.5% invasion probability or the Hormuz blockade becomes our persistent everyday reality, is your portfolio a Goldilocks or is it a bear? The data clearly shows us that the regime is shifting right beneath our feet. The ultimate question is, have you repositioned to meet it? Thank you guys so much for joining me on this deep dive. Keep your eyes on the tape, and I'll see you next time on The Explainer.